The preparation of financial statements is the culmination of the financial reporting process and represents one of the core objectives of IFRS accounting standards. Financial statements communicate the financial position, financial performance, and cash flows of an entity to investors, lenders, regulators, and other stakeholders, enabling informed economic decision-making. IAS 1 Presentation of Financial Statements, IAS 7 Statement of Cash Flows, and related IFRS accounting standards prescribe the structure, content, and presentation requirements of financial statements to ensure consistency, comparability, and faithful representation. A complete set of financial statements comprises the Statement of Financial Position, Statement of Profit or Loss and Other Comprehensive Income, Statement of Changes in Equity, Statement of Cash Flows, and accompanying notes. The preparation of these statements requires the application of recognition and measurement principles established throughout IFRS accounting standards. Statement of Financial Position. The Statement of Financial Position presents the entity's assets, liabilities, and equity at the reporting date, providing information regarding its financial structure and liquidity. IAS 1 requires separate presentation of current and non-current assets and liabilities unless presentation based on liquidity provides more relevant information. Typical asset classifications include property, plant and equipment, investment property, intangible assets, investments, inventories, trade receivables, cash and cash equivalents. Liabilities generally include trade payables, borrowings, lease liabilities, tax liabilities, provisions, deferred tax liabilities. Equity normally comprises share capital, share premium, revaluation surplus, retained earnings, and other reserves. The Statement of Financial Position reflects the accounting equation. Assets equals equity plus liabilities. Accurate preparation requires appropriate recognition, measurement, depreciation, impairment, and fair value adjustments in accordance with relevant IFRS accounting standards. Statement of Profit or Loss and Other Comprehensive Income. The Statement of Profit or Loss and Other Comprehensive Income, OCI, reports financial performance during the accounting period. Profit or loss includes income and expenses arising from ordinary business activities, including revenue, cost of sales, gross profit, operating expenses, finance costs, taxation, profit for the period. IAS 1 permits expenses to be classified either by nature, such as depreciation, salaries, and raw materials, or by function, such as cost of sales, administration, and distribution. Items recognized in other comprehensive income represent gains and losses excluded from profit or loss by specific IFRS accounting standards. Common OCI items include revaluation gains on property, plant and equipment, fair value changes in certain equity investments classified at FOCI, foreign currency translation differences, remeasurements of defined benefit pension plans. Total comprehensive income equals profit for the period plus other comprehensive income. This measure provides a broader assessment of changes in equity arising from non-owner transactions during the reporting period. Statement of Changes in Equity. The Statement of Changes in Equity explains movements in each component of equity between the beginning and end of the reporting period. Its primary purpose is to reconcile opening and closing equity balances by separately identifying transactions with owners and comprehensive income generated during the year. Typical movements include profit for the period, other comprehensive income, total comprehensive income, share issues, dividend distributions, transfers between reserves, prior period adjustments, changes in accounting policies. The statement demonstrates how retained earnings and other reserves evolve over time and enables users to distinguish operating performance from owner transactions. It also enhances transparency by showing the relationship between profit, comprehensive income, and changes in shareholders' equity. Preparation of the Statement of Cash Flows. The Statement of Cash Flows, prepared in accordance with IAS 7 Statement of Cash Flows, reports cash inflows and outflows occurring during the reporting period. Unlike accrual accounting statements, it explains actual cash movements and provides information regarding liquidity, solvency, and financial flexibility. Cash flows are classified into three categories: operating activities, investing activities, and financing activities. For financial reporting, FR, the indirect method is used to calculate operating cash flows. Indirect method of operating cash flows. The indirect method begins with profit before taxation, or operating profit depending upon presentation, and adjusts for non-cash items and working capital movements. Common adjustments include adding back depreciation and amortization, adding impairment losses, removing gains or losses on disposal of non-current assets, adjusting for finance income and finance costs where required. Working capital adjustments include changes in inventories, trade receivables, trade payables, other operating assets and liabilities. Finally, income taxes paid and interest paid or received are incorporated according to IAS 7 classification requirements to derive net cash generated from operating activities. Investing and financing activities. Investing activities include purchase and sale of property, plant and equipment, acquisition and disposal of investments, purchase and sale of subsidiaries, loans advanced to third parties. These cash flows indicate management's long-term investment strategy and future productive capacity. Financing activities include share issues, loan proceeds, loan repayments, lease principal repayments, dividend payments. These activities explain how the entity finances operations and investments through debt and equity. The sum of operating, investing, and financing cash flows reconciles the opening and closing cash balances reported in the Statement of Financial Position. Financial reporting significance. The preparation of single-entity financial statements requires consistent application of IFRS recognition, measurement, presentation, and disclosure principles. The Statement of Financial Position provides information regarding financial position. The Statement of Profit or Loss and other comprehensive income explains financial performance. The Statement of Changes in Equity reconciles equity movements. And the Statement of Cash Flows explains liquidity and cash management. Together, these statements provide a comprehensive representation of an entity's financial activities and support informed decision-making by investors, creditors, regulators, and other stakeholders. Their integrated preparation ensures that financial reporting achieves the fundamental objectives of relevance, faithful representation, comparability, and transparency established within the IFRS conceptual framework.